thing that we're quite focused on from a business perspective is improving the product to help the decision-making process, particularly for risk managers and portfolio managers who, particularly in a year like 2020, have seen asset prices really dominated by macro risk. And to be able to really get an insight into these deep underlying relationships between your portfolio and these kind of really important macro variables. And if we can put more confidence around that, even add this probabilistic layer, that would be extremely useful. The second thing we're thinking about is really to, and I'd love to know what you think about this theoretically, is to really step back and say, well, we know that macro variables impact asset prices. We also know that the equity world focuses on these style factors. And so why don't we, it's pretty likely that the style factors have some correlation with the macro environment. So, in a zero and negative real rate environment, growth seems to do much better. And it's sort of intuitive, the styles that are more attractive are partly a function of this macro environment. And so, one idea that we're working on, and we're talking to a bunch of potential partners who produce these style factor indices, is to actually combine the equity style factors and the macro factors, and then show, number one, a three-way split. How much of your asset price variation is determined by macro? How much of your asset price variation can you ascribe to style factors? And how much of your asset price variation is kind of true idiosyncratic, really about the nature of that company? And you could actually have other factors. I mean, there's climate as a factor. You could have climate variables in there so that you could really boil down the anatomy of an asset into all its component parts and really get an understanding of how much is truly idiosyncratic and how much is a bet on a factor and which factor. And then on top of that, you could have some sort of probabilistic overlay to that to give you a level of confidence around those results. I think that could be potentially powerful. Do you think there's any particular issue with combining these macro factors and these style factors?
No, I mean, I think it's a really interesting and exciting thing to do. I think the style factors are kind of interesting in that, it's a little bit subjective. I mean, certainly individual managers, I'm sure, have their own quantitative criteria for doing it, but it's a little bit one of these things. It's a little bit in the eye of the beholder, necessarily. And so when you're looking at kind of your strategy for this, presumably you'd like to be able to reason exactly as you said about, okay, so when this asset price moves, is it moving because is this a thing I can explain in terms of its kind of style membership, if you will, that it's a kind of thing that is responding well to macro factors? Can I explain this? Is this an idiosyncratic effect, as you say, or is this actually explainable by macro factors that are not acting through it, say it being a growth stock, right?
Yeah.
And so these are disentangling that, I think, is really important. I mean, there's a lot of different things that you could imagine discovering, right? From making more interesting decisions about whether you want to be shifting, say, towards value or growth. You could imagine making interesting decisions about saying, I want to invest in, I want to invest in value, but I want to factor out climate, say, right?
Yes.
You could make these really interesting decisions in which you sort of condition your style decisions based on certain kinds of exposures that you want to have, right? And so I think it's very complementary, allows you to disentangle effects, but then also reason about the combination of effects. And that's because you probably do have views on things, right?
Yeah.
That you want to, on particular macro factors that you want to get exposure to or not. But you still have this other larger big picture, like this is a time where I want to be buying value because of the larger economic picture.
And where it becomes really exciting, and we have this baskets technology, sort of portfolio optimization technology, is if you then put the power in the hands of the portfolio manager to say, right, here are the dials, these are the factor exposures I want. I don't want to have climate exposure. I don't want to have growth exposure. I want to have value, and I want to have
Yeah.
emerging market growth, because I think emerging market growth is, on a secular uptrend. Those are the two big factor bets I want. Here's the universe of assets I'm allowed to invest in. Here are some constraints on concentration, so I can't have more than 5% of my portfolio in anything. Maybe add some other types of constraints around liquidity, for example. Hit go, and bang, there's your portfolio.
There it
So
is.
that really becomes super exciting for the asset management world. And we're really fortunate that we have the opportunity to work with both you and Mike to help us with the right techniques to implement these things and put them on the right technology backbone and get them out there. So
It's exciting stuff.
it's very exciting.